We might need to start the recession countdown to 2026 because one of the most important leading economic indicators in the United States just flashed a warning sign that it's only done twice in the past 20 years, once in November of 2007 and the other in February of 2021. And that leading indicator is the ISM Services PMI, which as you can see has been decelerating since the October 2024 highs. We focus on services because the United States is a service-based economy, not a goods-based economy. Services make up roughly 80% of the entire GDP. Now, the two main components of the ISM Services PMI to observe are new orders, which has been decelerating, as well as prices, which has been doing the opposite and accelerating to new highs. What's interesting is that if you overlay these two charts together with prices in orange and new orders in blue, you can see that ever since December of 2024, there's been a divergence, which you can see with that alligator mouth opening. And the reason why this is significant right now is because both have crossed their significant thresholds. One for prices, it's above the 67 index, while at the same time, the new orders index is below 54. This is not healthy because prices are rising to extreme levels while demand is dropping to extreme levels. And if you go back the past 20 years, you've really only seen this two times. One in February of 2021, which really you didn't get a sustained deceleration in new orders below that 54 level, but then you had it really start to diverge back in November of 2007. You can already see why this is significant because if you overlay the S&P 500 in white there, you can see that this front runs these major drawdowns that last over 3 months. And if some random dude on the internet like me is observing these things, you bet that these guys are too, and it has them nervous. And it's not just me saying this, just look at their actions. There's a reason why they're ramping up their massive debt buyback program like they've done back in 2002. And so if you're someone who can't wait for the Fed to pivot again and continue rate cuts, I would just highly recommend you take a look back at history, seeing that the majority of market drawdowns have happened after the Fed started to aggressively cut rates. And right now we're currently seeing the dollar go bullish and bond yields go bearish, which is typical of a risk-off environment, but we'll see if that happens. Now, if you want to track this stuff yourself, we have a free PDF called the Ultimate Macro Investing Toolkit that gives you a list of indicators for you to look at for yourself every single week. All you have to do is DM me the word toolkit, and I'll go ahead and send that to you. Now, the reason why I'm saying start the recession clock for 2026 and not 2025 is because one, there's very low credit stress in the credit markets right now, as well as all of the can kicking being done by the Treasury and the government right now. Those could last for several more months. But that doesn't mean sell or short the S&P 500 as it clearly remains in bullish trend for now. But what do you think? Let me know in the comments below, and I will catch you in the next video.